Good morning, everyone. I'm Vince, and this is going to be the Hartnett Flow Show walkthrough entitled, his title is The Long Bond. Um, it's actually very interesting this week, not because of some deep concept he talks about, but because of the deep concept he doesn't really talk about that much. And that is the politicization of inflation. He talks, well, as a quick overview, the bottom line here is inflation doesn't play well politically. And for all these reasons, he believes inflation will be squashed and there'll be some more fiscal responsibility. And that's one of the reasons he continues on his bullishness for the long bonds, for the 30-year bond. So that's a continuation of what he's been talking about most aggressively last week. What's different, and I guess kind of makes him a little bit of a soothsayer in this regard, is that he's noticed that the populace, especially the millennials who haven't experienced this kind of inflation before, were really upset about it. And I think politicians forgot how unpopular inflation can be, especially when you haven't experienced it in a while. The Fed certainly had forgotten it, and they thought a little inflation would be tolerated. But people don't like inflation. It's that simple. And that's how you have to look at Biden's presidency, despite all the other things like cooked numbers, meaning stocks are at all-time highs, and he's struggling economically because of the inflationary scar that was created or manifested more during his term. And the reason I'm bringing all that up is because, first of all, Hartnett recognizes that inflation doesn't play well to the crowd. Second, during the debate, they discussed inflation a lot, but it wasn't like I'm fixing it. They were blaming each other. Trump, look at the inflation he caused. Biden, well, I inherited it from you. And it's almost like it's become an albatross. Who is responsible for the inflation, right? And after the debate, among all the other stuff that was going on with should he step down, should he not, all that stuff, which is, important in of itself, but not the topic here. Economists they came out of the woodwork and started talking about how bad inflation could be under Trump if he wins again. Now, quickly, as an aside of the aside, when the debate ended, someone on Twitter, someone that I'm mutuals with, and I were having a back and forth, a joke about it. And the joke was, why do we not hear about the economist? And they're probably all huddled up, figuring out how they're going to justify the joke that he said was, they're all figuring out how they're going to justify backing Biden after that conversation. And that was a good observation, because soon thereafter they came out. I think I made a comment like they're all hanging out together and they're all going, you go first. I'm not going to go first. You go first. That was like my punchline to it. But they did come out, and I'm going to put this up for you. All right. On the right-hand side, I Googled Trump, economists, and inflation. Okay. Look at the days ago. Trump's policies would cause inflation to surge, economists say, 2 days ago. Newspapers largely failed to report Trump's inflationary policies, and economists have taken upon themselves to yada, yada, yada. 16 Nobel Prize winning economists. Axios omits crucial details about economists who say Trump will destroy the economy. Now, that's the right-wing version. They're probably looking at it saying, well, here's what Axios left out. And here's the Axios story. Let's pop that open. 16 Nobel economists see a Trump inflation bomb. Oh, that's good. That's good, right? I didn't even look at it yet, but while each of us has different, here's the Economist wrote, while each of us has different views on the particulars of various economic policies, we all agree that Joe Biden's economic agenda is vastly superior to Donald Trump, the 16 economists write in a letter first obtained by Axios. All right. So remember the 50 scientists, or not 50 scientists, 50 uh, ex-intelligence people that were telling us, it was a Russian hoax. Well, now you've got 16 economists telling you that Trump's inflation will be worse. Now, it's not going to change your mind, and it's not going to change my mind, and it's not going to change the people in the middle's mind. Okay, for the most part, what it's going to do is it's going to remind them why they want Biden. Even if they don't want Biden, they don't want Trump. It's a way of saying Biden's bad, Trump is worse, or Biden may be suffering from dementia or sundowning every day, but his policies will remain even after he's gone. This is an attempt to saddle Trump with inflation, and there are meritorious statements to that. However, they're the same policies that Biden will have, and he's already said that. We'll get into that in a second. So I wanted to bring that up because the story behind the story for the Flow Show, the long bond, is that the politics, and Hartnett says this in here, the politics of inflation are, he doesn't say that, he says it's bad for politics. Inflation is something bad for politics. And you could see them in the debate trying to push it back on each other when they weren't talking about something stupid like golf scores or weight. All right, so we're going to go through that. Now, I haven't read this, but I've peeked at it enough, and I scanned through the Zero Hedge premium report, and that has informed me enough. In fact, the Zero Hedge report post is really good because they combined it with Rabobank story to make the case. Now, we have the stories as well, but let's go through this. Oh, sorry about that visual there I gave you. All right, scores the long bond. The long bond. That's what he's saying. Scores on the doors. Here, I'll give you a little bit of a scream room there. How do I stop that? There we go. Scores on the doors. Crypto 34.5%, oil 14.4%, gold 12.7%, stocks 11.8%, commodities 9.8%, US dollar 4.5%, high yield bonds 2.7%, cash 2.6%, investment grade bonds minus 0.4%, government bonds minus 4.9% year to date. The price is right. Investors long the rich sectors, Magnificent Seven, and short the poor sectors. We talked about that last week. REITs and small caps and ARK. Cyclical middle class sectors, industrials, home builders, resources, Nikkei, DAX, are rolling over. MSCI, ACWI equal weighted index now minus 0.6 year to date. Positive bonds. I think he's saying that is positive for bonds. Tail of the tape, Asian currencies, Japan yen, China renminbi, I'm tired of trying to say that right. Close to multi-decade lows, chart 3. There we go. Strong US dollar, Asia is super competitive. Less fiscal stimulus and no rate cuts. That's part of the reasons that Asian currencies are the way they are. US manufacturing suffers. No manufacturing states of PA, Wisconsin, Michigan will decide the election. Positive bonds, negative dollar, and have to. So everything he's saying is leading him to believe to positive bonds. This is good for bonds. This is good for bonds. The biggest picture. Biden and Trump responsible for two largest deficits of the past 80 years. Chart 2. But inflation is the number one issue for the electorate, which is related to deficits, but it's a manifestation of the deficits. But inflation is the number one issue for electorate. U.S. government spending is down 2%, rolling 12-month basis. Fiscal excess wanes bigly in year 1. New presidential cycle, chart 5. I'll put that up in a second. An election sweep scenario, bond is negative, but split scenario, Congress bond positive. Latest probabilities are Trump split Congress 40%, Biden split Congress 25%, Trump sweep 25%, Biden sweep 10%. Okay, this is I think his beyond macro comment. All right, We'll just take it sentence by sentence because they're all separate things. Biden and Trump are responsible for the two largest deficits of the past 80 years. Period. That's a fact. Chart 2. Here we go. There they are. And before that, it was under Truman. But inflation is the number one issue for the electorate. And by the way, he talked about that last week, especially since there's more millennials and Zoomers and Gen X, that's us, or me anyway, voting, and they know about inflation or are worried about inflation. However, and this is something he's been bringing up, U.S. government spending is down 2% on a rolling 12-month basis. So we're spending less than we were 12 months ago. We're still spending too much, but you have nowhere to go but down when you've been that high. And fiscal excess wanes bigly in year one new presidential cycle, chart 5. All right, now he's had this up here before, but the concept basically is you wind down fiscal stimulus going into the election, and the first year after the election, it's actually, it wanes bigly, okay? Chart 5. An election sweep, however, okay? That's what the word he's not putting in there, however. An election sweep scenario is bond negative. Sweep meaning they take all three branches, right? House, Congress, president. That's it. So a sweep is negative for bonds because it would be a mandate that you can spend, similar to, I don't know if he had a mandate. He probably did. What Obama did. All right. But split scenarios, which is the more likely ones, is positive for bonds. The latest probabilities are Trump wins with a split Congress, 40%. Biden wins with a split Congress, 25%. Trump sweep, 25%, meaning he gets the mandate. And Biden sweep, 10%. Okay. I want to overlay how I think about this. If there's a sweep, it's negative for bonds. If there's not a sweep, it's positive for bonds. I'm thinking about bonds here, right? So you can look at this and say, I am 65% sure that 65% probability that bonds will go up despite whoever the election is. And I'm 25 to 35% sure bonds will go down afterwards. So if you want to play the odds, that's one way to do it. Another way to do it would be to say, do nothing and wait for the election. And after the election, pick. You may miss the first knee-jerk reaction, but you'll probably be good for the next 10 months. It's a matter of approach to this, but that's a trade. And he's looking at that trade probably in a combination of the way I just did. Buy some now, buy some now, and add later or take off later. All right. So I think it's a pretty important paragraph. Weekly flows 8.7 billion to stocks, 7.3 billion to bonds, 3.0 billion to cash, 0.9 billion to gold, and 0.5 billion from crypto. High yield bonds, largest outflow, flow stenos. High yield bonds, largest outflow in the past 10 weeks. TIPS, largest outflow in 3 months. Emerging markets, largest debt inflow in 3 months. Stock inflow in 20 weeks. Okay. They're easing there, but everyone's easing over there again, I guess. Tech, largest outflow in 16 weeks, reversing record inflow from last week. That's significant. XLK ETF rebalance flips from 8.2 billion inflow to 8.6 billion outflow. Okay. He's choosing to, and I'm not saying he's wrong, but he's choosing to see this as money out of tech is bearish for stocks unless it goes into other stocks downstream. Remember the cyclical hopefuls, right? If they're selling tech and buying stocks, you're broadening the market. You're showing not necessarily a flight to safety, but you're showing a cycle that's kicking in. So it's where the money goes that's coming out of stocks that will influence his opinion on if we are going to have a sell-off in stocks. And I know that he thinks we're going to have a sell-off in stocks. We're getting closer to his D-Day. All right. Energy, largest outflow since March 23, chart 9. There you go. Okay. So energy would be a beneficiary if the market was broadening, right? So if people taking their money out of stocks, out of tech stocks and putting into cyclicals, energy would benefit. He's not seeing that despite a strong oil market. So based on the data so far, I'm concluding that he's saying stocks are not going to go up or not keep going up.